Hi, Rob Lukey with ShopProp Realty. I'm going to do a quick update of what I think is going to happen in 2022 in the real estate markets. I usually do one once a year. I think we have enough data now that we can kind of put something into place of how I expect the market to act, especially with the Fed's decision to start raising interest rates. But does that alone impact the market is the question, and I'll say no, and I'll get to that in a second. But I would say the first thing to take a look at is this U.S. national average that we saw at the end of November and September. This is the Case-Shiller index as of the end of November, up over 19% on a national average in the real estate market. Now, did some markets do better? You know, we had Phoenix up 33%, we had Dallas up 25%. So the point that I would make to you is everybody's feeling a little bit richer when it comes to real estate, but the reality is that everywhere is up, right? So from a reality of that, you're going to one place to another, you're still seeing that increase in real estate prices. And some of the ones that are up the most are the ones that got hurt the most in the Great Recession in the late 2000s, right? 2007 and so forth, 2008. So let's talk about what's going to happen, or what we think is going to happen in the next year in 2022. When you talk about a 19% return year over year, we know that's not sustainable. Something has to happen, whether it be a recession is coming, or interest rates are going up, or a combination of those two. We know interest rates are going up, but we know that doesn't alone impact the market. I mean, when you look at interest rates that have moved up, we saw interest rates moving up in the early 1980s, and this is the spike that we saw in inflation when I said that we saw those year-over-year returns in real estate that were bigger than what we saw even last year with the inflation that we saw, and we'll get to that in a second. But this isn't sustainable either, right? But we had interest rates creep up into I think they got as high as 12% in this area right here during this hyperinflation of the Carter administration. So one of the things that we know is that the Fed is already in the point of trying to stop this inflation. This is what we're seeing right now. So when you look at the year-over-year return, even if we saw a national index of 19.5%, that's part of we had 7% inflation. So now we're at 12%. Year-over-year return on a national average. So my point that I would make to you is that just from a standpoint of getting inflation back under control, which probably is going to happen this next year, that takes 7% off the market, at least for year-over-year returns. So my thought process is that with the Fed's decision to go off and raise interest rates, you're going to have buyers in the short term looking to get into properties before interest rates go back up. That means that we might see an increase in prices in the first quarter and even the first half of next year. I think the second half of next year is probably where we're going to see some type of slowing down, or at least some type of even a potential drop in the overall prices. Now, last year I said that the second half of the year, I thought we would see maybe a slowdown as well. And we did. When you look at it right around June, we saw a slowdown. Problem is that inflation continued to rise, right? And the interest rates, we didn't make any moves from a monetary standpoint to stop that. So the inflation continued to rise. Markets started to continue to see that increase. But overall, I still think when we approach the end of next year, we're going to see some kind of slowdown. So that's my thought. Overall, I hope everybody has a great holiday season. I'll see you in the upcoming year. www.shopprop.com